Welcome to The Explainer. Today, we are diving deep into a really core concept in finance. How exactly do companies account for buying other companies? It's all governed by this rulebook called IFRS 3, and right at the heart of it is this fascinating and sometimes pretty controversial idea called goodwill. Okay, so let's kick things off with a basic question. When one company buys another, what are they really buying? Well, the rules are super clear on this. You can only use what's called acquisition accounting if the thing you're buying is an actual business. And a business, it's not just a random pile of assets. It's got to be an integrated system with inputs, processes, and outputs all working together to create some kind of value. So here's how we're going to break this down. We'll start with what a business really means. Then we'll walk through the accounting rulebook, see how goodwill actually gets calculated, touch on why the whole method is a bit controversial, and then wrap up with why this invisible asset matters so much. Right, so let's just lock in this key idea right away. A business is so much more than its physical stuff. It's the organized system that uses all those assets, the people, the secret sauce, the processes, to actually make money. This distinction is the foundation for everything else we're about to talk about. Okay, so this is where our main rulebook, IFRS 3, steps onto the stage. It gives us a very specific set of steps called the acquisition method, and you have to use it for every single business combination. It's all about keeping things consistent and transparent. So IFRS 3 lays out 4 absolutely crucial steps. First, you've got to figure out who the buyer is. Seems obvious, but it's step 1. Second, you pinpoint the exact date control changes hands. Third, and this is a huge one, you have to measure everything you just bought. And fourth, you calculate and book any goodwill that pops out. Now, it's that third step, the measurement part, where things start to get really interesting.
And that brings us to maybe the most critical rule in this whole process. It's this. The acquired company's assets and liabilities, they have to be remeasured at their fair values on the day of the acquisition. We don't really care what they cost years ago. What we need to know is what they're worth right now, today.
This brings us to a really important distinction. See, an asset's carrying amount is its old school historical cost. It's what's written in the seller's old accounting books. But its fair value is its current market price. So a piece of land that was bought for, say, 10 grand decades ago might be worth $50,000 today. Under IFRS 3, it's that fresh $50,000 figure that the buyer has to put on their books. Now, this fair value rule applies to all identifiable assets. What does that mean? Well, basically, it's anything that you could sell on its own or that comes from some kind of legal right. This covers the obvious stuff like buildings and equipment, but also, and this is so important, valuable things you can't touch, like brand names, patents, or customer lists, even if the seller never had them on their own balance sheet. All right, so all this work of valuing every little piece brings us to the main event. How do we account for the premium an acquirer pays, the amount above the fair value of all those individual parts? I mean, why would a company even do that? Well, they're paying a premium because they believe the whole business is worth more than the sum of its parts. But how in the world do you account for that extra cash you shelled out? The accounting world has a very specific formula for this. You take the purchase price, that's A. You add the value of any part of the company you didn't buy, that's called the non-controlling interest, or B. And then you subtract the fair value of all the net assets you were able to identify, C. Whatever is left over, that gets recorded as an intangible asset called goodwill. Let's just put some quick numbers to this so it makes sense. So let's say the total value implied by the purchase is $155,000. But when we add up the fair value of all the identifiable bits and pieces, it only comes to $120,000. See that $35,000 gap? That is your goodwill. And here's the crucial point. That 35 grand doesn't just disappear into thin air. Nope. It's captured on the buyer's balance sheet as a separate intangible asset called goodwill. It basically represents the premium they paid for all that future potential. But we have to be honest here. This whole method isn't without its controversies. Accounting for a business combination is not a perfect science, not by a long shot. It involves a whole lot of judgment. Yeah, so critics often point out a few key problems. For one, figuring out the fair value of something unique, like a famous brand name, can be really, really subjective. And that creates a huge headache for investors. Because how do you compare a company that buys its brands with another company that builds them from the ground up over decades? It's almost impossible.
But despite those challenges, you absolutely cannot ignore Goodwill if you're reading financial statements. It's the accountant's best attempt to put a number on things that are real and valuable, even if you can't touch them.
I think this quote just nails it. Think of Goodwill as the bucket for all the valuable stuff in a business that you can't individually identify and slap a price tag on. Its amazing reputation, its brilliant team, its killer location. It's the price you pay for the secret sauce, for that future potential. And this leaves us with a final, really big thought to chew on. Goodwill often makes up a huge chunk of a company's assets after they buy someone, but it's not cash you can spend, and it's not a factory you can use. So how do we, as investors, as analysts, truly measure the worth of something as invisible, yet as important as a company's reputation?